A very good evening. Thank you so much for tuning in to today's episode of The Business Age. On today's edition, we are coming to you live from the Central Bank of Rwanda, where the Monetary Policy Committee meeting took place to review key economic indicators and decide on the central bank repo rate, among other monetary policy measures. On the episode today, we'll have a sit down with the chief economist to really understand some of the key outcomes and what they mean for the country's economic outlook. You will be with me, Naringwa Fiona Muthoni.
The global inflation is reducing to 5.8% this year, from 6.8% in 2023, and we had 8.7%, if you remember, in 2022. So it has been going down, and it's expected to continue this downward trend even past beyond this year. Sub-Saharan Africa registering the same downward trend, though slightly still higher than the global average, so reducing from 15.8% last year, 2023, to 13.1% this year. So that is the summary of the global economic performance that really are linked or impact on what we see on the domestic front. So looking at the domestic economy, the real economic performance remains strong. As you saw in the numbers published by the Institute of Statistics, the first 3 quarters of last year, we registered stronger growth than was projected. Overall average of 7.6% for the first 3 quarters. And when you look at the composite index of economic activities, these are frequent economic numbers we track here at the central bank. We see the fourth quarter remaining strong as well. So the composite index of economic activities increased by 7.2% in the fourth quarter. And as you see that graph, normally our composite index of economic activities is always in the same direction as the overall real GDP performance at the end of the day. And so with this, we expect to see 2023 performance higher than the 6.2% that was originally projected, based on the numbers we already have for first 3 quarters, but also the composite index of economic activities we saw in the fourth quarter of last year.
The Monetary Policy Committee opted to keep the central bank rate steady at 7.5%, citing the efficiency of its tight monetary policy approach in curbing inflation, aiming to stabilize it within the target range of between 2 to 8%. The decision comes in the wake of elevated inflation figures throughout 2023. In October last year, we ventured into the streets of Kigali to gauge public sentiment on the impact of inflation on their daily lives.
Prices have been increasing since 2021. When we got into the COVID period, it seemed like the world was in a crisis, mostly because we rely on modern agriculture. In many countries that depend on agriculture, were heavily impacted by the pandemic as farming activities came to a halt. Afterwards, we had a good rainy season, and neighboring countries like Tanzania had a bountiful rice harvest in 2022, and rice prices fell to 14,000 Rwandan francs per bag. One would buy a kilo of rice between 700 Rwandan francs and 800 Rwandan francs. But after what seemed to be a recovery from the COVID period, we started experiencing climate change issues. Populations continue to increase worldwide, while the food remains insufficient due to climate change. That caused the food prices to soar. For example, a kilo of beans that used to sell 350 now sells between 1,800 to 2,000 Rwandan francs.
Before the COVID-19 period, we used to sell a kilo of green bananas at 250 Rwandan francs, but now we're selling it at 450 Rwandan francs. The price increases are a result of the bad weather patterns. The prices have changed. Before the COVID-19 period, potatoes retailed at 250 Rwandan francs per kilo, but after the pandemic, prices shot up.
The government did well to remove VAT on rice and maize flour. In March this year, rice was retailing at 48,000 Rwandan francs per bag, and we have to sell a kilo at around 2,000 Rwandan francs. But now, good quality rice retails as low as 1,200 Rwandan francs because the government did away with the VAT.
Subsequent to that, there has been a decline in inflation figures, indicating moderation in food prices. The most recent inflation data for January 2024 reveals headline inflation standing at about 5%, remaining within the National Bank of Rwanda's target range for the second consecutive month. We interviewed the chief economist at the National Bank of Rwanda to analyze and interpret the latest statistics. We're just going to start by dissecting some of the numbers that have been shared with us on this MPC for this coming quarter. Just start by highlighting some of the key indicators that came out of the MPC.
That's the first MPC of the year, 2024. So we are looking at the latest development, what has happened in the fourth quarter of 2023, taking stock of what has happened throughout the year 2023, and then trying to look at what are the new projections for this year 2024, and then take decision on the monetary policy stance. So in a nutshell, we saw not so much changes on the global side, but we saw new risks coming from trade disruption, global uncertainties around wars that are happening here and there in Ukraine, Israel, and in the Middle East. We saw uncertainties around shipments through the Red Sea that could affect transport globally. But all in all, the global growth is around 3.1%, and is estimated to be the same this year, around the same this year, 2024. Global commodity prices are reducing throughout the year 2023, and they are expected to continue reduce. That's an energy index, so may it be fuel mainly, and foods and non-foods commodities globally. Locally, in our domestic economy, we saw a strong growth, 7.6% for the first 3 quarters of 2023. We are, with all the indicators that we are tracking that are more frequent, we see that this growth will continue in the fourth quarter. So most likely we'll have a GDP growth that will exceed the initial projections of 6.2% for 2023. And on the side of inflation, we've seen inflation coming down. We've seen this trend is mainly explained by different factors. There's the previous decisions by the central bank to tighten monetary policy. There's what we see as good harvest and efforts that were put in place to boost agricultural production at the end of the year. So we see now fresh food prices are coming down. And as a result, we have an inflation in January of 5%, which is exactly the target we wanted, from more than 20% at the beginning of the year. On the external sector side, we saw pressures coming from imports, while exports growth is quite slow. Trade deficit widened last year by 10%. That has put pressure on the exchange rate. Our currency depreciated by 18% last year, which is unusually very high. But we gradually are seeing that this adjustment will allow competitivity of our exports, and therefore trade deficit normalizing, and this depreciation is also expected to normalize going forward. So the message of this MPC is to say that inflation is back to the target. We are expecting inflation to continue around 5% this year. We see risks coming from global geopolitical tensions. We see that risks, of course, our agriculture in the future might be affected by climate change events that are unpredictable. So the MPC decided to maintain the central bank rates at 7.5% to ensure that this stability in inflation continues before maybe in the future considering a rate reduction gradually.
The MPC decided to maintain the rates at 7.5%. We also know November 2023 it also took the same stance, decided to maintain it also at 7.5%. But looking on the flip side, you said inflation is currently within bandwidth, and we're expecting it to be at an average of 5% throughout the whole of 2024. So one would wonder, what are some of the underlying risks that you still see or you still foresee that also led to the decision of maintaining the repo rate?
It's the first time in the coming 2 years, 1 year and a half, that we are back to the bonds. So what we are really looking at is stability. So this inflation to remain within the band of 2 to 8% durably. So that's the main objective of the MPC. This is why MPC decided to actually maintain longer the current stance, ensure that prices are inflation is durably within the bands before considering a reduction. So the risks that we are seeing are the risks I mentioned. What is happening with global trade is very uncertain right now. Another reason to maintain is to really see how this will unfold in the coming months. If, for example, by the time for mid-year or in the following months, we see that really it has not affected our economy, or it has affected our economy just to the extent that we actually projecting it, because to explain a bit, we are having different scenarios when we discuss. And the baseline scenario is the scenario that is most likely to happen. This is the scenario where we are saying it's around 5%. But there could be, if for example, the disruptions in the Red Sea continue, affecting transport costs durably, that could have an impact that could be greater than what we anticipate. So that's what we are trying to see and monitoring. Is this going to happen, or are we going to stay within the risks that we identified and the quantification of this risk throughout our modeling that's giving this projection of 5%. So it's really the reason why MPC decided to maintain for now and monitor if this is materializing. Then we'll be comfortable in saying that it is time to reduce.
Food inflation in itself, just comparing to the other statistics, remains relatively high. We saw the food index gained about 7.0% year on year. That's also not ignoring the fact that it also eased by around 1.3%. How do you foresee the trends in 2024, and what are some of the measures that are being put in place to just maintain it at a lower level?
Yes, you're right, it has been high, but it's coming from very high. As you said, it's coming from very high. If you look at just fresh food, so basically those that are produced domestically, right now, I think by January it was below 5%, just a fresh food item. And this trend is likely to continue, thanks to actually a very good season of agriculture. The harvest started around December. So December and January is when we see supply of food in the market. This is the reason why most of the items like Irish potatoes, beans, and vegetables in general started reducing. So that's what makes us confident, because season A is a big season. It's actually more than half of the production of the year. So until April, May, prices are likely to remain low. Then if we have another good season and an harvest that is coming in May, then throughout the end of the year, we'll see prices that are stable and low. So that's what is in our projections, basically. So the efforts that have been put in place at the Ministry of Agriculture and the government in general to ensure a good harvest in season A, it's continuing. So that's giving us comfort that we'll have a good supply of food throughout the year. If there's no really unexpected climate-related events, then prices will remain within this trend and even come lower.
We saw the Rwandan francs depreciated at a value of about 18% in 2023. How are we foreseeing the trend in 2024?
This depreciation was because of unusual pressure on our imports and demand for forex, as it was explained, but we are seeing a normalization this year. We are seeing that because the trade deficit is likely at least will not extend to this, will not be at the same level as what was recorded last year. We anticipate a reduction in imports, an increase in the growth of exports this year. We anticipate good performance of the services sector still, with tourism sector. We anticipate good performance of remittances, good sources of inflow, and foreign direct investment, FDI. So all of this is going to contribute to a normalization of the situation in terms of supply and demand of FX, therefore putting less pressure on the Rwandan franc, which is going to normalize.
Do talk to us about the trade imbalance numbers in particular. And when you say we foresee them narrowing, is there a specific target?
The trade balance, the difference between exports and imports. If you just look at the goods, because services is another story, as I said, it is actually improving. But the trade in goods is the main cause of this imbalance, because the trade in goods is in deficit, and the deficit is widening. So as of last year, this deficit widened by around 10%. That means that it was already negative, but the deficit, this value is actually larger. So there are a couple of things. If you look at what happened last year, there has been a combination of factors. So there was a slow growth of exports. One of the main reasons is because international commodity prices dropped. As you know, in 2022, we had a big increase in oil prices, all commodity prices, and the reverse happened in 2023. So that's true for some of the commodities that we actually export, like coffee and tea, and some minerals. The price becoming lower has affected the value of our exports. That's one. But on the other hand, on import side, we had a boom in some import component, like for example, import of food. As you know, last year, the first half of the year especially, the agriculture production was not good. Therefore, we needed to import a bit more food, right? So what is giving us hope that it's not going to happen this year is because, first of all, the production domestically is good, so the need for import of food is not the same. Most likely we see a slowdown, a reduction even in import of some food components that will put less pressure on import overall. And the pace at which this decrease in international commodities was happening is not the same this year. And at the same time, there are a lot of projects ongoing and a lot of efforts towards increasing production of coffee, for example, and its value added, of tea, of minerals, etc. So therefore, we have hope that exports this year is going to be much, much bigger.
How has that translated to the private sector credit growth and the overall private sector performance?
So the private sector credit growth, we saw a very, very high increase in 2023 in terms of both outstanding credits and new loans. So basically new authorized loans, the way we say, from the banking sector. The credit to private sector was close to 20%. It was like 19.9% in 2023, which is quite high. This is because banks, and we talked about the profitability of banks and the fact that they have goods. All the indicators are positive for banks. Banks are giving more credits to the private sector. May it be large or small corporates or even individuals. And some of the sectors that are driving it are individual loans, commerce, and things like that. So basically, we see continuous growth and at a very high level in terms of financing the private sector. And this is also one of the reasons why we are seeing good economic growth, because with this financing, then enterprises invest, and when they invest, basically GDP increase.
The government securities have traded higher, especially
Yes.
looking at the shorter end of the yield. What really attributed to that, looking at the growth in appetite in 2023, do we expect it to be maintained in 2024?
This was expected because it is in line with the monetary policy stance. For the past 2 years, the central bank decided to increase the rate gradually by 300 basis points, so by 3 percentage points, from 4.5 to 7.5. And this had an impact on all other short-term maturities, especially the money market rates, the way we talk about. So the rate at which banks lend to each other, interbank rate increased. The T-bills, government T-bills rates increased, all the way even to T-bonds. So that was expected. When monetary policy stance is tightened, then all rates increase. The only rate that did not increase in our case is the lending rate, commercial bank lending rate. But all other rates increase. So to answer your question, if we look at the outlook and we say that this time around the Monetary Policy Committee decided to maintain, if going forward this rate is reduced, then expect also the trend to reverse for other rates. So it has increased because of this increase in the CBR, but going forward, if the CBR is reduced, it will reduce. So now it is maintained, probably it will be stable for the moment.
What is the overall look for the financial stability?
Financial stability, we did not see any major issue so far. So the financial sector is sound and stable, and it's expected to continue that way. If you look at all the metrics made in the banking sector, microfinance, and all other, so sound and stable finance system in general, and in Rwanda, despite the challenges that we have been talking about globally.
We saw positive growth in loans. How are we seeing that translating to the NPLs? And what are some of the risks as well that could be perceived within the financial stability space for this year?
Normally, when you talk about high growth in loans, you might think about risks around NPLs, but so far that's not what we are seeing. The NPL ratios for all the components are quite within the range, are below 5% as of end December. I think some of the reasons behind it is mainly linked to these risks that we are talking about that are better managed by banks and by other institutions, financial institutions, the fact that economic activity that we are seeing now is also contributing to increasing income, and therefore companies, borrowers' ability to repay their loan. So I think it's all linked. Yes, we had high inflation, but at the same time we had good performance on the side of GDP, and we have not seen this NPL ratio increasing much, and it's still within what we are expecting.
And what are the risk factors when you're looking at 2024? Still a lot of geopolitical tension, still even looking regionally in itself. So how do we see everything that's happening externally? How will it be imported and impact the local markets?
Yes, so first of all, we've talked about it from the point of view of the fact that our economy is resilient to these global shocks. That's what we've seen. And the fact that our inflation is now more dependent on supply of food than the rest, and that's being stabilized. Now, if you look at the financial sector, it's also a bit similar in a way that we are not very much exposed in terms of the regional how our banks are exposed to the regional financial system. So therefore, there's no concern about the stability or big risks that may come from regional financial system and global. The same last year when we saw after the Fed tightening, we saw the impact and some of the issues with some U.S. banks that went into turmoil. We did not see any impact from this to our domestic financial system. So we are confident that the financial sector remains stable.
We were interested in understanding investor sentiments regarding the decision of the National Bank of Rwanda to maintain the central bank rate. We interviewed Kevin Karobia from BK Capital, an investment and wealth advisory firm, to gain insights into this matter.
Our expectations were that the MPC will maintain the policy rate at 7.5%, being of the view that it had worked to bring down inflation towards the target band. Looking at the last 2 months, inflation was single digit and within the BNR's target range. However, we still felt that there were some pressures, especially not in the Rwandan frame, coming over from the global markets and then slowly spilling over to the Rwandan market, that make it difficult to relax monetary policy at the moment. But we expect to see that in the coming meetings during the year.
We've seen the inflation numbers have been relatively low within the bandwidth for the month of December as well as January. Yeah. Do you feel like the numbers have really translated and the general public can feel the difference?
I think one of the key areas to tackle or to look at it is a base effect. So the inflation numbers that we are seeing, for example, for January 2024, this is an year-on-year comparison with January 2023. If we look at Rwanda's inflation curve, where inflation started getting heavy was towards the end of 2022 and early 2023. So in as much as the inflation rates are single digit and lower at the moment, we also have to be appreciative that they were coming from a higher base effect during that period. That's why it's a bit difficult for consumers to feel the impact now. But especially for food prices, as we continue to have better agricultural production, I'm sure that before the end of the year, then that impact will now be felt in a better way.
Could you give us an in-depth look into the commodity prices, the commodity outlook? How are we seeing, especially the outlook for 2024 relative to what we saw in 2023?
I think the key one to look at it there, especially is on like vegetables index, for example. If you look at January 2024 CPI numbers, vegetable prices were constant, which is key actually, considering that that's a common or a staple food and a very big contributor to the food index. However, we are still seeing pressures on, for example, oils, cooking oils that are still not stabilized.
How should we expect also the external pressures to be imported within the local economy?
Yeah, imported inflation is going to be a challenge, and depending on how the global factors play out, we expect to see some movement on that. Because, for example, let's look like at fertilizers, which are a very key input in agricultural production. When geopolitical tensions started to arise from the Russia-Ukraine conflict, fertilizer prices shot up the roof, moderated a bit in 2023, and some of those factors we can't really. There isn't much that can be done locally about them because you're importing them. Prices are high globally, and they are basically going to affect our index. But looking at, for example, agricultural produce from Rwanda specifically, with at least stable rainfall, with more predictable weather patterns, we expect that this will moderate. When going by the outlook given by the governor today, we expect that with the bumper harvest and better rainfall expected in 2024, then we are going to see these prices moderate. And food being the highest contributor to the CPI at 44%, then should food prices become stable and we don't see spikes in that, then we expect that inflation will not be a huge challenge.
The positive outlook, how even the MPC being made, the repo rate being maintained at 7.5%, how will investors be looking at it? How will this be translated into some of the investments that are coming into the country?
Looking at it right from when the MPC started hiking in February 2023, when in February last year, that's when there was a 50% hike. The market, especially on the shorter end of the yield curve, has factored that in. If you look at the yield curve currently and compare it with previous periods or a similar period last year, you can see that the shorter yield of the curve has adjusted to the new lending environment. However, if we look at the bonds, the changes there have been slight changes, but they have not been very much. If you look at the shorter end, then at that point you can see that investors are really putting in aggressive bids for the treasury bills, pushing. Now the 364-day paper is yielding 10.5%, which is historic highs. So on the shorter end, we are seeing investors really pushing hard to get rates that are reflective of the MPC rates.
And that wraps up today's episode of The Business Age. Thank you so much for tuning in. As always, you can share with us your questions and feedback on social media. Tag us at The Business Age. You were with me, Naringwa Fiona Muthoni. Bye for now.